A famous quote by Helen Gurley Brown: "Money, if it does not bring you happiness, will at least help you be miserable in comfort." And this quote is 100% true. This course is all about demystifying finances, debunking myths, and giving you the tools to rock your financial game. This is the second part of the course, Money. In the first part, we've discussed all the basics of money. If you haven't watched the video yet, watch the video to understand the basics of money. In this one, we will learn about the banking and financial institutions. And before we get started, make sure to subscribe to our channel, because we know you always want to learn something new every day. Where are banks? Imagine a bank as a safe place that holds your money and helps you manage it. It's like a giant piggy bank that keeps your money secure and allows you to access it when needed. Banks provide various services to individuals and businesses, such as savings accounts, checking accounts, loans, and investment opportunities. Banks act as intermediaries between those who have excess money, called depositors, and those who need money, called borrowers. Now let's look at some of the roles of banks. Safekeeping and storage. Banks are like secure vaults or safes where people can store their money. Just as you might deposit your valuable items in a safe deposit box at a bank for safekeeping, individuals deposit their money into bank accounts to keep it secure. Accounting deposits. Banks accept deposits from individuals and businesses. When you deposit money into your bank account, it becomes an asset for the bank and a liability for the bank to you. This allows the bank to use those deposits to provide loans and other financial services. Lending and borrowing. Banks lend money to individuals, businesses, and governments. This is similar to a friend borrowing money from you when they need it. Banks provide loans to people who need funds for various purposes, such as buying a home, starting a business, or paying for education. The interest charged on loans is how banks earn income. Payment services. Banks offer payment services to facilitate the transfer of money. When you use a debit card or make online payments, the bank acts as an intermediary, transferring money from your account to the recipient's account. It's like using a messenger to deliver money on your behalf. Investment services. Banks also provide investment services, allowing individuals and businesses to invest their money and earn a return. It's similar to hiring a financial advisor who helps you invest your savings in stocks, bonds, or other financial instruments that can grow your wealth. Economic stability. Banks play a crucial role in maintaining economic stability. They help regulate the money supply, control interest rates, and provide liquidity to the financial system. Just as a thermostat regulates the temperature in a room, banks help regulate the flow of money in the economy to promote stability and growth. Supporting businesses and economic growth. Banks support businesses by providing loans for expansion, investment in new projects, and working capital. This support is like providing fuel to a car engine, allowing businesses to operate, grow, and contribute to the overall economy. Banks also play a role in facilitating international trade by providing trade financing and foreign exchange services. Financial security and trust. Banks provide a sense of security and trust to individuals and businesses. When you deposit your money in a bank, you have confidence that it will be safe and accessible when you need it. It's like having a trusted friend hold your money for you, knowing that they will keep it secure and give it back when you ask for it. Now let's explore the different types of banking services. We'll try our best to simplify the concepts. Deposit accounts. Deposit accounts are a type of banking service that allows individuals to deposit and store their money with a bank. There are two main types of deposit accounts. Checking accounts. A checking account is like a wallet or a personal cash register. It allows you to deposit money and withdraw funds easily. You can write checks or use a debit card linked to your checking account to make payments or access cash. It's convenient for day-to-day transactions, such as paying bills, making purchases, or withdrawing money from ATMs. Savings accounts. A savings account is like a piggy bank or a safe. It's a place to keep your money safe and earn interest on your savings. It's meant for long-term saving goals or emergency funds. You can deposit money into a savings account and let it grow over time while still having the flexibility to withdraw when needed. It helps you accumulate funds for future expenses or financial goals. Loans and credit services. Banks provide various loan and credit services to help individuals and businesses access funds for different purposes. Let's look at some of the examples. Mortgages. A mortgage is like a loan specifically for buying a home. It's similar to borrowing money from the bank to purchase a house, and you repay the loan with interest over a specified period. The house you buy acts as collateral for the loan, meaning the bank can take possession of the property if you fail to repay the mortgage. Personal loans. A personal loan is like borrowing money from the bank for personal reasons, such as paying for a wedding, funding a vacation, or consolidating debt. It's similar to getting a financial boost when you need extra funds. Personal loans typically have fixed repayment terms and interest rates. Credit card. Credit cards are like financial tools that allow you to borrow money from the bank for purchases. It's similar to having a pre-approved line of credit that you can use to make purchases up to a certain limit. You need to repay the borrowed amount within a specified time frame, and if you don't pay the full amount, interest charges may apply. Electronic banking. Electronic banking services provide convenient ways to access and manage your finances using technology. Let's look at some of the examples. Online banking. Online banking is like having a virtual branch of your bank accessible through the internet. It allows you to check account balances, transfer funds, pay bills, and perform other banking transactions from the comfort of your home or any location with internet access. It's similar to having a bank branch at your fingertips. Mobile banking. Mobile banking is like having a mini bank in your pocket. It involves using banking apps on your smartphone or tablet to access your accounts, make transfers, pay bills, deposit checks by taking photos, and perform other banking tasks on the go. It's convenient for managing your finances while you're out and about. ATM. Automated teller machines are like self-service banking kiosks available 24/7. They allow you to withdraw cash, deposit checks or cash, transfer funds, check account balances, and more. ATMs act as convenient access points to your bank accounts, similar to having a mini bank teller available anytime you need it. Let's look at some of the banking regulations and supervision. Government regulations on banking operations. Government regulations are rules and laws established by regulatory authorities to govern and oversee the operations of banks. These regulations aim to ensure the stability and integrity of the banking system and protect the interests of depositors and the overall economy. Capital requirements. Governments often impose capital requirements, which mandate that banks maintain a certain level of capital as a buffer against potential losses. This helps ensure that banks have sufficient financial resources to cover risks and absorb losses. Reserve requirements. Governments may also set reserve requirements, which specify the minimum amount of reserves that banks must hold as a percentage of their deposits. These reserves act as a safeguard against liquidity risks and ensure that banks can meet withdrawal demands from depositors. Anti-money laundering and know your customer regulations. Governments impose AML and KYC regulations to prevent money laundering, terrorist financing, and other illicit activities. Banks are required to implement procedures to verify the identities of their customers and report any suspicious transactions to regulatory authorities. Risk management and reporting. Governments establish regulations to ensure that banks have robust risk management practices in place. Banks are required to assess and manage various risks, such as credit risk, operational risk, and market risk. They are also required to provide regular reports on their financial condition and risk exposure to regulatory authorities. Consumer protection laws. Consumer protection laws are designed to safeguard the rights and interests of bank customers. These laws aim to ensure fair and transparent practices by banks and promote consumer confidence in the banking system. Truth in Lending Act. This law requires banks to provide clear and accurate information about loan terms, including interest rates, fees, and repayment schedules. It enables borrowers to make informed decisions and understand the true cost of borrowing. Fair Credit Reporting Act. This act regulates the collection, sharing, and use of credit information by banks and credit reporting agencies. It grants consumers the right to access their credit reports and dispute any inaccuracies. Electronic Fund Transfer Act. This act protects consumers in electronic fund transfers, such as ATM withdrawals and debit card transactions. It ensures that consumers are informed of their rights and liabilities and establishes procedures for resolving errors in unauthorized transactions. Basel Accords and capital requirements for banks. The Basel Accords are international regulatory standards developed by the Basel Committee on Banking Supervision. These accords aim to promote financial stability and establish consistent capital requirements for banks worldwide. Basel III. Basel III is the latest accord, introduced in response to the global financial crisis of 2008. It requires banks to maintain higher capital buffers and introduces stricter risk assessment and disclosure requirements. Basel III aims to enhance the resilience of banks and reduce the likelihood of future financial crises. Capital adequacy ratio. The Basel Accords set capital adequacy ratios, which mandate that banks maintain a minimum amount of capital in relation to their risk-weighted assets. This ensures that banks have sufficient capital to absorb losses and continue operating even during economic downturns. Risk-based approach. The Basel Accords advocate for a risk-based approach to banking regulation. Banks are required to assess the risks associated with their activities and allocate capital accordingly. Riskier activities, such as lending to borrowers with higher credit risk, require higher levels of capital. Let's explore non-banking financial institutions, including insurance companies, pension funds, and mutual funds. Insurance companies, life insurance and property insurance. Insurance companies are financial institutions that offer protection against financial losses resulting from specific risks. They provide policies to individuals and businesses to mitigate the impact of unforeseen events. Here are two common types of insurance: life insurance and property insurance. Life insurance. Life insurance is like a safety net for your loved ones. It provides financial protection to your beneficiaries in the event of your death. You pay regular premiums, and in return, the insurance company promises to pay a lump sum or regular payments to your beneficiaries. It helps ensure their financial security and can cover expenses like funeral costs, outstanding debts, or income replacement. Property insurance. Property insurance is like a shield for your assets. It protects your property, such as your home or car, against damages or losses caused by events like fires, theft, or accidents. By paying premiums, you transfer the risk to the insurance company, which will compensate you for covered losses. Property insurance provides peace of mind and helps you recover financially from unexpected events. Pension funds and retirement planning. Pension funds are financial institutions that manage and invest funds to provide income in retirement. They play a critical role in retirement planning and long-term financial security. So how does this work? Employer-sponsored pension plans. Many employers offer pension plans as part of their employee benefits package. Through these plans, a portion of your salary is deducted and contributed to a pension fund. The fund invests the contributions, aiming to generate returns and grow your retirement savings. When you retire, you receive regular pension payments based on the accumulated funds and plan specifications. Individual retirement accounts, or IRA. Individual retirement accounts are personal retirement accounts that individuals can set up independently. You contribute to an IRA with pre-tax or post-tax income. Depending on the type of IRA, the funds are invested, allowing them to potentially grow over time. In retirement, you can withdraw from the IRA, either as a lump sum or in regular distributions, to support your living expenses. Pension funds and retirement plans help individuals build a nest egg for retirement and ensure financial stability during their later years. Mutual funds and investment companies. Mutual funds and investment companies are financial institutions that pool money from multiple investors to invest in various assets. They offer individuals the opportunity to access diversified investment portfolios. Let's look at how they work. Mutual funds. Mutual funds collect money from investors and use it to purchase a diversified portfolio of stocks, bonds, or other securities. Each investor owns shares in the mutual fund, proportionate to their investment. Professional fund managers make investment decisions on behalf of the fund, aiming to generate returns for the investors. Mutual funds provide an easy and convenient way for individuals to invest in a diversified portfolio without directly managing individual securities. Investment companies. Investment companies offer a range of investment options beyond mutual funds. They may provide access to individual stocks, bonds, exchange-traded funds, and other investment instruments. Investment companies may offer different investment strategies and cater to various risk profiles and financial goals. Mutual funds and investment companies allow individuals to participate in the financial markets and benefit from professional investment management, even with smaller investment amounts. Now we will explore financial markets and instruments, including stock markets, bond markets, and derivatives. Stock market. Stock markets are platforms where shares of publicly traded companies are bought and sold. Let's look at some key elements. Equities. Equities, also known as stocks or shares, represent ownership in a company. When you buy shares of a company's stock, you become a partial owner and have a claim on the company's assets and earnings. Investing in equities allows individuals to participate in the growth and success of companies. Indices. Stock market indices, such as the S&P 500 or Dow Jones Industrial Average, measure the performance of a group of stocks representing a particular market segment or the overall market. They serve as indicators of the health and direction of the stock market. Initial public offering or IPO. An IPO occurs when a private company offers its shares to the public for the first time. It allows the company to raise capital by selling shares to investors. An IPO provides an opportunity for individuals to invest in newly listed companies and potentially benefit from their growth. Bond markets. Bond markets are where bonds, which are debt instruments, are bought and sold. Bonds represent loans made by investors to governments or corporations. Government bonds. Government bonds are issued by governments to borrow money from investors. Investors lend money to the government and, in return, receive periodic interest payments and the repayment of the principal amount at maturity. Government bonds are considered relatively safe investments as they are backed by the full faith and credit of the issuing government. Corporate bonds. Corporate bonds are issued by corporations to raise capital for various purposes, such as expansion or investment. Investors lend money to the company and receive regular interest payments and the return of the principal amount at maturity. Corporate bonds carry varying levels of risk depending on the financial health and creditworthiness of the issuing company. Derivatives. Derivatives are financial instruments that derive their value from an underlying asset or reference rate. They allow investors to speculate on price movements, manage risks, and engage in various investment strategies. Futures. Futures contracts are agreements to buy or sell an asset at a predetermined price on a future date. They are commonly used in commodities, currencies, and stock market indices. Futures contracts enable investors to hedge against price fluctuations or speculate on future price movements. Options. Options contracts give investors the right, but not the obligation, to buy, call option, or sell, put option, an asset at a predetermined price within a specific period. Options provide flexibility and are often used for hedging or speculative purposes. Swaps. Swaps are agreements between two parties to exchange cash flows based on different financial variables. Common types of swaps include interest rate swaps and currency swaps. Swaps allow parties to manage risks, hedge against interest rate or currency fluctuations, or achieve specific financial objectives. That concludes our second unit of the course: Money, Banking, Financial Institutions, and Stock Market. Stay tuned for the next video where we'll continue our discussion about money. Don't forget to subscribe so you won't miss out.